Shawn, you're still fading this rally, aren't you?
I think you're supposed to fade the rally. It's been a great return over a couple months, and the marketplace offers you opportunities. The opportunity was already established, created. You should now capitalize on it and fade the rally.
You think the dollar's going to underperform this year?
I think the dollar is probably peaking at right around now. So on an indice basis, 97 handle will be the high. So you should be looking to fade that as well.
You think so? When is, I assume you're expecting global weakness to start hitting our shores.
Absolutely.
But when and how? Look, construction spending this morning doesn't suggest that.
We've already seen Europe is slowing down clearly. China is slowing down as well, so we've got problems there. And our economy is slowing down. The question is, it's not going to stay at 3% plus growth, so it's going to go to 2% and potentially a little lower in 2020. So you're going to have slower growth. The question is to what degree?
The argument now seems to be whether Q1 is a pothole that we quickly recover from or something more endemic, right?
Yeah, I think to the point you were making, a lot of the data that we're looking at now would say that some of this weakness is going to be transitory. We're going to slow down a little bit in the beginning of the year, and then we're going to pop right back up from that. We saw strong durables orders, strong construction spending, strong retail sales. All this data is coming back now, and the rest of the world is stabilizing, so I'm not so sure about this.
Is the rest of the world stabilizing?
I think you're seeing that out of China. It's very early days, but you're beginning to see the leading economic indicators pointing in an upward direction. So I think we feel a little bit better about China. Europe is really still up in the air. I think that we have to wait and see.
And look, we've had a lot of monetary policy coming as well. So all of a sudden liquidity has been pushed into the system, and that's shorter term in nature, right? So that's clearly helped out the markets and helped out the economies. The question is, what will it do a year from now versus today?
But I was going to say, you really want to fight that wave of new liquidity from central banks and the new posture from the Fed, listening to the markets? There's
the economy and there's the market. Right? So the market doesn't have to rally if the economy is doing a little bit better from a lower base. But I look at it this way. We're going to be a slower growth economy on a global basis this year versus last year. And I certainly think 2020 is going to have some credit implications as people have to roll their corporate debt. And that's going to be a challenge.
You're not disagreeing with that, are you?
We're definitely going to be a slower growth economy. I think the question is, how much slower? Is this slowing down to something that looks like below potential growth? We're looking at recession. Or is this still an economy that's growing above potential? And even though I would agree that equities have probably gotten a bit out ahead of this, can the fundamental economic data ultimately come back and support that? So even if we slow down to something like 2% plus, I think that's still an okay scenario.
Does corporate debt remain a concern for you if rates look like they've topped?
I still think it's a concern. So you have $2 trillion of corporate debt rolling in the next 3 years.
But worse than the alternate scenario.
Wait, is that IG? Is that IG or is that
IG?
Yeah.
Right. So, but that's compared to 800 billion over the last 3 years. So it's a significant amount of roll that has to occur. And let's face it, all these companies that we're talking about, their earnings potential isn't as high as it used to be. Margin pressure is now being talked about by everyone as well. So that's going to be a concern as well. So it doesn't have to affect the entire system. If it affects the bottom 10%, that puts real pressure on the economy and what credit is going to look like going forward.
So you think this is going to be the year of fallen angels, so to speak? We're going to see some high profile?
I think next year.
Next year?
Yes, I think 2020.
What do you make of that?
Yeah, I think a lot of these risks I would push out into 2020 as well. I think 2019 can still look pretty good in the sense that we're getting relatively strong growth and low inflation, and that means central banks can be very, very patient and wait and see, and that's all supportive of risk assets.
I mean, Shawn, there's been no sign that there hasn't been demand for U.S. debt, whether it's government debt, corporate debt, as the Fed keeps sort of kicking the can down the road here on interest rate hikes this year. Where do you see the turning point happening?
Well, at the top of every cycle, it feels great. Right, so we're sitting at the top of the cycle. Leveraged loans are easy to get. Everything's pro forma. You look at private equity firms, they're buying on an EBITDA basis around 14 times multiple versus 9 in the prior 8 years. So there's real leverage that's being put into the system that it feels good now. The question is, what will people look like a year from now, especially when we start to see earnings power not be as strong as it was? You could have potentially revenue issues. I mean, we're still looking at growth in an earnings basis still being single digits this year, right? Down substantially. So what's going to happen in 2020 will be the key.
Hey, Shawn, on the subject of sellers, we didn't have a chance to talk about this, so I know you may not have had a real look at it, but Oaktree selling 62% to Brookfield. I mean, you just launched an alternative asset manager. Any thoughts in terms of the significance of that deal?
Look, I think it's always interesting.
Is it the top that you're talking about in some way, Howard Marks?
When hedge funds sell their business, it always is a sign that they believe it's a top in the earnings cycle, at least from their perspective. So whether there's still there's margin pressure from the hedge fund side as far as 2 and 20 or what it's going to look like going forward, but you're also going to have less return profile. And I think, look, Howard Marks is probably a little bit different because he's maybe looking to cash out. He's been doing this for a long time and been incredibly successful. So I don't think it's really a precursor to what's going on. But you always have to be a little skeptical when hedge fund guys sell their business.